Canada lost 25,000 jobs last month, and yet the unemployment rate fell to 6.5%. How does that even make sense? It doesn't. Unless you understand what's actually happening underneath the headline. 120,000 Canadians quietly vanished from the labor force last month. They just stopped looking. It's the largest non-pandemic decline since early 2022. We call this false tightness. The job market looks healthy on paper, but it's an illusion. And this illusion has the Bank of Canada stuck. Today, I'm going to explain why rates could stay frozen for months, maybe longer. And I'm going to talk about what the US recession signals mean for Canadian mortgages and why the smartest play right now might be a fixed rate with an escape hatch. Let's get into it. If you're new here, I'm Greg Williamson. I have 30 plus years in the Canadian mortgage business. This channel exists because I believe mortgages should be managed, just like investments are managed, not guessed. Every week, I cut through the noise, explain what's actually happening in the rate market, and give you a clear strategy, not a hedge. If you want someone who actually makes calls, then subscribe below. Let me walk you through what actually happened in January's jobs report because the headlines got it completely wrong. First, the numbers. Employment fell by almost 25,000 positions, virtually all part-time, mostly in Ontario, and mostly in manufacturing. Private sector payrolls dropped by 52,000 positions. Manufacturing employment is now down over 50,000 since Trump returned to office. Capital economics called tariffs a wrecking ball. Wage growth has decelerated to 3.3%. By every measure that matters. The job market has softened. But here's the twist. The unemployment rate fell from 6.8% to 6.5%. That's the lowest since September 2024. How? Because 120,000 people left the labor force. They stopped looking for work. They no longer count. David Rosenberg put it perfectly. Had the participation rate in the market not sagged to 65% from 65.4%, the jobless rate would have risen back to 7%. 7% unemployment. That's what the real picture looks like. Now, why does this matter? This is what we mean by that false tightness. The unemployment numbers look tight, 6.5%, not bad. But the underlying reality is weak. Jobs are being lost, people are giving up, manufacturing is bleeding. And here's the problem. The Bank of Canada looks at that 6.5% headline and says, hey man, the labor market's okay, no urgency to cut. But they also see the actual job losses and say, we can't hike either. They're stuck. And this is subtle but important. When unemployment falls because people leave the workforce, not because hiring is strong, you get this weird situation. The labor supply is shrinking, the slack in the market is disappearing, but growth doesn't improve. The Bank of Canada is boxed in. Too little hiring to justify hiking, but not enough measured slack to cut aggressively. Our conclusion is this. This false tightness could trap rates in neutral for months, with cuts unlikely unless there is clear demand destruction, which could come. Translation is don't expect big moves. Short-term rates could stay right where they are for a long time. Now, let's check our dashboard. These are the signals that we track every week. Canada's 5-year bond yield is still around 2.9%, stubbornly elevated, just like we talked about that last episode. Despite the weak jobs data, yields barely moved. Markets shrugged off the whole report. Why? Because the headline unemployment rate looked fine. False tightness at work. The gap between fixed and variable is only about 30 to 40 basis points right now. That's tight. The Bank of Canada is holding at 2.25%. The next decision is March 18th. Markets expect another hold. Friday's data reinforced the street's view that rates will stay where they are through most or all of 2026, with any hikes pushed off to 2027. That's what the markets are saying. I think there's something else at play. But the bottom line is the market has settled into an uneventful 2026 mode, but don't take that to the bank. We still have CUSMA fog, and we have money printing and currency debasement actively happening in the US. It makes it so that I think we still have rate cuts that are possible. Hikes definitely feel like they're a long ways away. Now, let's look south of the border because what happens in the US eventually hits us. Now, while everyone's focused on hot inflation data and hawkish Fed talk, there are growing signs the US economy is weakening underneath. Despite reports of high GDP that seems all tied to bubbly AI CapEx movement, the real truth is the job market is cracking. More than 100,000 job cuts were announced in January, and that's the highest January total since 2009, the last recession. Job openings have fallen to their lowest since 2023, and when hiring slows and layoffs rise, consumer spending usually falls next. Signal number 2 is tech credit stress. Tech loan distress is around 14.5%. That's the highest since 2022. Tech bond distress is near 9.5%, highest since 2023. Add this to the rapid lowering of the previously insane multiples that largest tech stocks have enjoyed for some time. It's causing those same Mag 7 stocks to drop despite showing good returns. When companies face debt stress, falling stock prices, and less cash for stock buybacks, they cut costs, they freeze hiring, they reduce spending. It feeds on itself. Signal number 3 is housing demand in the US is collapsing. Home sellers in the US now outnumber buyers by about 530,000 people. That's the biggest gap ever recorded. Housing is one of the largest parts of the economy. When housing slows, it drags everything else with it. Signal 4 is the Fed is not easing despite all this economic weakness. The Fed is still hawkish. Rate cuts are paused. Now, Trump nominated Kevin Warsh as the new Fed chair. Markets read him as a hawk, although he's also nodded along with Trump's calls for cheaper money, fresh uncertainty. Our call is, despite what Warsh has said in the past, the math cannot be ignored. The US is dangerously close to a debt spiral and will have to have massive money printing to likely support yield curve control, or cut spending and go into austerity, which of course won't happen as no one gets reelected by cutting spending and voluntarily putting their country into austerity. Signal number 5 is bear steepening. This is the one most people miss. The US 2-year versus 10-year yield spread has moved to its highest level in 4 years. When the yield curve uninverts because short rates are falling faster than long rates, that's a soft landing signal. But when it uninverts, which is happening now, because long rates are rising faster than short rates, that's called bear steepening. Historically, bear steepening has always preceded recessions. So let's connect the dots. Job cuts are rising, hiring is falling, corporate debt stress is increasing, housing demand is collapsing, Fed is staying hawkish, and the bond market is signaling recession. These are the kind of signals that, if they play out, force the Fed to cut eventually. And when US short-term rates fall, Canadian short-term rates also could fall. So we have two forces at work. Let me walk through what each one means for your mortgage. Scenario number 1 is a recession. If the US does tip into recession, here's the sequence. Growth collapses, unemployment spikes, demand destruction, the Fed is forced to cut, even if reluctantly. There's a flight to safety, money flows into bonds, US long-term rates fall. Canada follows too because the Canadian bond market has a 92% correlation with the US bond market historically. The Bank of Canada gets covered a cut, or at least at minimum. Again, can't hike into that kind of environment. Canadian bond yields also fall, which means fixed rate mortgages fall. Variable rates fall as the Bank of Canada cuts. In this scenario, both short-term and long-term rates come down. Scenario 2 is rates stay frozen. The job market shows false tightness, what we're seeing now. Unemployment looks good on paper, but the Bank of Canada has no urgency to cut, but growth is weak, so they can't hike either. We get stuck in neutral for months, maybe years. We have history to prove this. From November 2010 to November 2014, which is 4 years, Canada's prime stayed frozen at 3%. Unemployment stayed in a 1-point range that entire time. When economies get in a rut, rates can stay flat for a very long time. Here's the wild card, stagflation. This is the third scenario that I need to mention. What if growth stays weak, but inflation stays sticky? Maybe from tariffs, supply shocks, AI-driven investment keeping GDP afloat in the US while jobs disappear. That's stagflation, and it's messy. In stagflation, the Bank of Canada is still stuck. They can't aggressively cut because inflation is still a problem, but they can't hike because the economy is very fragile. Variable rates stay flat or drift modestly lower, but fixed rates, they can stay sticky or even rise because bond investors demand extra yield for that inflation insurance that they're looking at. The key insight, even in stagflation, Canada is more likely to ease than the US because we're the weaker economy. We have more household debt, we have trade stress the US just doesn't have, And the Bank of Canada simply cannot hike into a contracting economy with CUSMA uncertainty and a fragile housing market. That breaks things really fast. So what's the play? Let me give you my call, and I'm going to give it to you direct. The reality check is if you're waiting for rates to fall significantly, you might be waiting longer than you think. Now, don't expect significant cuts barring a crisis. History shows that crises that drive down rates might happen once a decade or so. I've laid out some options that this could happen, but those who are waiting for lower rates may be waiting longer than they think. That's just the truth. The gap is narrow. Right now, the difference between fixed and variable is only about 30 basis points. That's not much. That's a small premium for certainty. Fixed with an escape hatch is my call right now. Here's what I'm telling clients right now. If you want certainty, fixed rates make sense. The gap is narrow. You lock in, you sleep at night. But here's what makes working with us different. If you lock in a fixed rate today and rates drop 6 months from now, what happens if you're at your bank? You're stuck. They'll quote you a $15,000 IRD penalty to break that mortgage, and you can't capture the lower rate. With us, you have our penalty protection program. If rates fall and you want to relock at a lower rate in the future, we split the penalty with you 50-50 up to $5,000. Anything over $5,000 and you're capped at $5,000, and we would cover the rest. Means you'll never pay a penalty higher than $5,000. If the penalty is under $6,000 total, which is our target, we can blend it into your mortgage without a full refinance. This allows you to keep your insured or insurable rate. That's massive. So you get the certainty of fixed on the upside with an escape hatch on the downside. Here's how we manage it. We monitor your mortgage constantly. When rates drop enough that the math works, we reach out. We're not going to call you the day after rates drop a quarter point and the penalty is still massive. We wait for the sweet spot. When the penalty is manageable, when it's blendable, and when you'd actually save money, that's when we call. That's what managed mortgages look like. The bottom line is this: you're not betting on one outcome. You're positioning to win in multiple scenarios. I've laid out multiple scenarios that could happen. If the rates stay flat, you have certainty. You're fine. Rates rise, you locked in, you win. Rates fall, we split the penalty, you relock lower, you still win. That's the fixed with an escape hatch strategy. Here's the bottom line. Canada's job market is showing false tightness. The headline looks fine. The reality is weak. The Bank of Canada is stuck. U.S. recession signals are building, but that doesn't mean rates are coming down anytime soon. It could take a bigger crisis to move them, and crises don't happen all the time. If you're waiting for significantly lower rates, you might be waiting for years. The smart play right now is that fixed with an escape hatch. Lock in certainty, and if rates do fall, we've got you covered. If you want your mortgage managed, not guessed, subscribe at the button below, and if you want a personalized strategy based on your specific situation, click the link in the description or the pinned comment below to book a call directly with me or my team. Your mortgage is too important to leave the chance. Let's get it managed. I'll see you next week.